Thank you so much, everyone, for joining us this morning. My name is Danya. I am the Program Manager of Membership Engagement and Communications for Region 9 Headstart Association. And we are joined today by Bill Harmon and Beth Krasnow of Thrive, presenting a webinar on how employers can help employees who are students crush their student loan debt. I looked up some numbers before this because I was curious, and the average student loan debt in the United States is like 38 to $41,000. I exist within that number. I obviously graduated back in 2021, so this is near and dear to my heart. This is not a small problem, and I think financial literacy and stability is just absolutely crucial. So I'm excited to listen to this. I'm excited to be here today, and I'm really glad for the people that have shown up and decided to take the time to listen. I hope that you find value in this information, are able to present it to your agencies. And with that, I will pass this over to Bill and Beth, let them introduce themselves and get started. Thank
Thank
you.
you.
Great, thank you. So I'm going to start it off. I'm Bill Harmon. I'm the president of Thrive. I'll turn it over to Beth in a bit, but she is the founder and CEO of Thrive. And this is really a passion of mine, in that I spent 37 years in the retirement industry trying to help people save enough and get to that magical moment when they are financially prepared to retire. But I also realized that there are inhibitors to saving for retirement. And one of the biggest is student loan debt. And it's big and getting bigger. And you can see by this slide that there are 45 million Americans with student loan debt, totaling 1.7 trillion, and that is growing dramatically. A really big number is this 5.1 million that are in default. And I say that because I don't know if you saw the news, but the week of May 5th, these individuals that were in default received a letter stating that they're going to go to collections. And soon after that, they're going to have their wages garnished. There's another 5 million borrowers that are coming up. They're in the pipeline that will soon also be in default. So there'll be a total of about 10 million borrowers. If you look at the total number of people employed, that comes out to about 1 out of every 13 employees could be in default, could be soon sent to collections, and have their wages garnished. That is just ugly. And so this is such an important topic, but there are ways that we can help address all of this. Go to the next slide. When we think about this, because this falls into financial wellness topics, this talks about financial stress, productivity in the workplace suffers when you are having financial stress. It becomes a huge recruitment and retaining or retention type of tool. In fact, in the funny stat, right, the one in the middle, 58% of millennials say they prefer having a student loan benefit over additional vacation days. That tells you that through this survey that this really is important to millennials, which obviously are a very big part of the audience that has student loan debt, as well as centennials. And the next one, from retention, you can also see these stats are so big. In fact, 75% of the labor force will be in this year either millennials or Gen Z, the centennials I referenced earlier. So big part of this, your typical employee base is in this group and has student loan debt concerns. So we can move over to the next. How can we address this? Thrive can address this in two different ways. One way is through employer contributions. And this can be done either through, and we're going to go through these details, but a way just to go ahead and make a direct payment towards their student loans, or maybe a flexible match where you take your existing budget that you have for your employer match, your retirement match, or even through Secure 2.0, which many of you are familiar with. The other way is to meet with employees individually, look at their particular situation, and see if they are eligible for some of the federal student loan relief programs that are out there. If they're still out there, even the new administration's been reviewing them, but there are still many programs that are out there and available. It's hard to find them, navigate them, enroll in them, and make sure that you qualify for the right ones. So we have a team of experts that we'll talk about that can help with that. This is something that is big and getting bigger as far as employers really saying, I need to do something about this. It is a differentiating benefit, but only 17% of employers today offer some type of student loan benefit program, but 38% are thinking about adding something within the next 5 years. Now, contributions that the employer makes to the employee does have tax benefits. The employer doesn't pay payroll taxes on the contribution made to student loan debt, and those contributions are tax deductible. Meanwhile, the employee receives that contribution from the employer income tax free. So there are those benefits that go through the end of this year. It sunsets. We'll see if this new administration is going to renew that. I'm not going to predict, but it actually doesn't look horrible. There is a chance that they will renew it. So when you think about the different um, inhibitors to saving for retirement, I mentioned student loan debt, but there's also other ones. In fact, when we created these programs, we created it out of a need. An employer said, I feel bad that I have this very generous match and my employees aren't taking advantage of the match. Why is that? And I find out because they have student loan debt. Well, then later, as we introduced this program, we realized, well, no, there's also a problem in inadequate emergency savings. Some employees say, I don't have student loan debt. I worked 2 jobs during college, so I wouldn't have student loan debt. But you know what I do have? I have mortgage debt or credit card debt or inadequate emergency savings. So we opened up this to offer flexibility to where the employer can now make contributions to college student loan debt. They can make contributions to emergency savings. What if someone's saving for their children so they won't have student loan debt through a 529? Or maybe if you have a high deductible health plan, employees are concerned that they have a lot of out of pocket. And so they want to save for this out of pocket in their health insurance plan through a health savings account. So we offer this flexibility for you to really meet employees where they are in their financial journey through this. So we're going to dig in a little bit more on how the mechanics of this work. So here's an example. Let's say you have a retirement plan that has a dollar for dollar match to 5%. One employee may say, yep, I'm putting all my money into my retirement. That's where my world is right now. I'm trying to save for retirement. So they put their 5% in. The employer match is 5%. The next employee, option two, is that the employee says, I can't afford to save for my retirement. I am strapped in student loan debt. Everything I am focusing on is there. So then they put their 5% into the student loan debt, and the employer match also goes into the 5%. And then the third option is the employee says, well, I kind of like to split it up. I'm going to put 3% into my retirement plan. I'll take that 3% match. But I'd like the other 2% to go into my student loan debt or 529 or emergency savings. Then the other 2% match goes there. How does this work? This is a non-ERISA sidecar account. The employees make their election inside their 401k first. And they say, I'm going to put that money in there. And then when they stop, whatever they stop at, if they stop like an option two at 0 or an option three at 3%, that is keeping some money that was in the match formula unused. That unused match amount now can go outside the plan and go into these outside accounts. A lot of people ask, does that affect my testing? Do I have to change my plan document? You do not, because you are administering your 401k plan per the plan document with that match. When those employees stop below the match limit, now that leaves eligible dollars to go outside the plan, and you can make those contributions. We facilitate the administration of those contributions. We facilitate the enrollment. We facilitate then the payment into those individual accounts. But that doesn't affect your plan. We don't have to tie in with your record keeper, and it does not affect your testing. Now, another way of doing that outside the plan. So you have your retirement plan. We talked about your existing budget. So it's kind of nice in that example. You budgeted 5% of payroll. You might have been used to paying 4.5%, but inside that 5% match, you can now use those dollars. If you say, I want to create a separate budget, you can do that. And there's two ways of doing that. One, and these are examples to where an employer just says, I'm going to give each employee X number of dollars to go into an account that they choose. Student loan debt, 529, emergency savings. It could be, here's examples. Carvana does $1,000 a year. Google does $2,500 a year. Obviously, very competitive employment market for them, so they use that as a recruitment tool. Hulu or Staples, they do $100 a month for every employee. Those typically and historically have only gone to student loans, whereas we offer the flexibility to open it up to additional accounts like the 529 emergency savings or HSA. Now, another way of doing it is through an employer match, where you say, I kind of want the employee, rather than just getting free money, but they also have to be involved. So an example of some of our clients, we have a sports apparel firm that says, I'll match up to $100 a month of whatever you put into your accounts. Or a law firm does dollar for dollar up to 3%. Or an engineering firm, dollar for dollar up to $3,000 a year. So those are some of the examples to where this is a separate budget outside of your match budget in your retirement plan, where you could go and meet employees where they are in their financial journey. And again, reminder that anything that goes into the student loan, you get the first $5,250 as tax advantaged. The fees for this are $2,500 to set it up one time. And then we charge $6.95 per month for any employee enrolled in the program. We don't charge on all employees, just those that are enrolled in Thrive with these outside accounts. Okay. I should have also mentioned early on, if you have any questions, please go ahead and type them in the chat, and we'll keep an eye on that, answer them as we go along. But for the second part of this was the employer getting involved through matching dollars or contributions. The other way, kind of part of our 1-2 punch to really address student loan debt, is we have a team of experts that understand federal student loan relief programs. They're out there, but they're complicated. So Beth, do you want to talk about those?
Sure. Hi, hello, everybody. I am excited to talk about this program because I think this really hits home with all employees, but specifically nonprofit employees. And I'm sure most of you are aware of the federal programs, the federal relief programs that are offered. Why everybody isn't enrolled in these programs is a little bit of a complicated answer, but oftentimes these programs are hard to enroll in. Borrowers reach out to their servicer to get information, and that doesn't always give them the right information to take it from there. It's hard to stay compliant with the COVID payment pause and then payments starting up again. There was a lot of confusion there. And now, like Bill mentioned, all of a sudden, people who haven't made payments for various reasons, most of all because they were in forbearance through the payment pause, are now headed to collections because their loans are in default. So a lot of uncertainty, a lot of confusion around federal student loan programs. And with that May 5th ruling right now, that 5 million that are in default look to be about 10 million by this summer when garnishment will begin. So from the employer's perspective, this is going to be a big deal and a bit of an administrative nightmare when letters and notices start coming in that these employees are in default and now have gone to garnishment with not a lot of prior notice to the employees. So your employees are going to face some hurdles right now, and we offer really to be your go-to in all things federal student loans. And I'm going to talk a little bit about these programs and then what we do to support your employees. So for those who work for a nonprofit, you have a couple step processes to get yourself relief. One is to work for a qualifying employer, which is a nonprofit 501c3, make qualifying payments, be in a qualifying plan, make the set number of payments, and then you're eligible for loan forgiveness. So it is a multi-step process that shouldn't be as difficult as it is, but the number of people who get relief based on public service loan forgiveness is not very high. And, this administration in its first term forgave next to nothing. Then the Biden administration came and was attempting to make changes to that, and there was a whole lot of relief that was granted, and now we're sort of back to new rules, new, strict adherence to the programs, and that's going to really affect borrowers. But there is still a path to enroll in an income-driven payment plan. There is still a path to public service loan forgiveness. You just need to know how to do it. And I would venture to say most borrowers are going to get caught up in that, in that process. So having a go-to or experts in this field is something that is invaluable to offer to employees. So if you're not that familiar with the federal relief programs, when college graduates come out of school, they're on what's called a standard repayment plan for their loans, which is very similar to a mortgage. Your payment is your loan times the interest rate times, the period, the term of the loan. So for this individual that's earning $55,000, married, 3 kids, and has loans in the amount of $50,000, they're starting with a $530 payment, which is exorbitant when you look at, especially in California, an income of $55,000 with tax rates, what their take-home pay is. A good percentage of their salary is going to go directly to that payment, and that's not sustainable. So income-driven repayment plans, which came out in the early 2000s, shifts the payment that the borrower is on and says, we're going to look at both your family size and your income and change your plan to a payment that's affordable. Now, income-driven repayment plans have been shifting throughout the years, but there is still an income-driven repayment plan that is going to bring a borrower's payment down. Now, in this very extreme instance, because their income is such, their family size is such, their payment is going to be zero, which is going to still be considered a payment, but they just don't qualify to have to make a payment because of their finances. If their income was higher or their family size was lower, this would be adjusted to, let's say, $100 or $150 payment. But either way, once you're enrolled in an income-driven repayment plan, you make those qualified payments on time for 10 years, you will be eligible for loan forgiveness, and then you can apply for public service loan forgiveness. So that's the income-driven repayment plan. That's public service loan forgiveness. Why everyone is not on track or on target for loan forgiveness is oftentimes they're in the wrong income-driven repayment plan. The SAVE plan was a big plan that was offered, starting I think a year and a half ago. That the courts have said that's not a legal plan. So everybody who's in the SAVE plan needs to change their plan because any payments they're making are not considered qualified payments. Those who have Parent Plus loans, FIFA loans, older loans, they're generally not going to be in an income plan that is on track for loan forgiveness. So what we offer to borrowers is the chance to talk to an advisor to go through your loans and see what plan you're on, if you're even on a plan, and understand what's the right track to get, to move forward towards loan forgiveness. So that's a resource that's always been an incredible offer from employers, but there's never really been a better time than now to offer a resource because all of your employees that have federal student loan forgiveness are probably in a status that might need a change in order to be on track for loan forgiveness. The defaulted loans that are now going into collections, there are ways to get loans in rehab, garnished loans back to good standing. That's almost next to impossible to do on your own. And the garnishment of their wages are not even dollars that are going towards paying off their loan. They're going to the collection agencies. So those people stuck in a cycle of garnishment are never paying down those loans. That will be with them for the rest of their life unless they can get out of garnishment into a new income payment plan back to good standing. So that's one of the areas that we focus on, that we're experts in, helping employees who are already in really the worst case scenario, which is their loans have gone past the rehabilitation, past default, and are now being garnished. And that's a garnishment of your wages, Social Security, tax refunds. I mean, any income that you're eligible for, the government can garnish for your student loans. So this is something that we really work with borrowers to get on top of, get to the right side of, and get into a new payment plan so that they can be, in good standing and on the right track. Everybody knows about public service loan forgiveness, but one of the areas that are really key that a lot of borrowers don't know about is the temporary expanded public service loan forgiveness. And that's a program that says, hey, if you were denied public service loan forgiveness for more clerical or administrative reasons, but you've actually made all your payments with a qualifying employer, you can reapply for TEPSLF. This is a fantastic program borrowers know little about. This is one of the resources that's incredible to offer to your employees. So in terms of what do we offer? How do we get this in front of your employees? We offer a monthly webinar. These webinars are free, there's no cost, and all of your employees are welcome to join. We walk through everything that's going on with federal student loans today, changes, what you can do. We answer questions. So this is something that's open to all of your employees as just a tremendous resource that is sort of our first line of getting in front of borrowers to help them in any way that we can. The next thing that we can offer is the loan review. So that's the time where you have a one-on-one advisory appointment with one of our student loan experts. They walk through your loans, they'll log in with you to your servicer and get a sense of these are the loans you have, these are in good standing, these are in default, or you're in an income-driven payment plan that is not taking you through to loan forgiveness, or maybe you're still in a standard payment plan, whatever the case may be. They can check out payment counts, really give a great checkup of your federal loans and give you a sense of any changes that should be made to get you, to the place you want to be with your loans. Now, the webinars come at no cost. The loan reviews come at no cost. There will be borrowers who work with us who say, I want to enroll in this program. I need help. And for that service, there's a fee that the employees will pay. And then they engage us as their advisor, similar to what you do with your accountants or your lawyers. We become their student loan advisor. We complete all of their paperwork, we submit, and we really take them all the way through to completion. So that is a great additional resource that we offer. We have so many success stories, so many wonderful stories of borrowers who just felt like there was no relief there. One that we like to tell because it's so astounding is there was a doctor who took out loans in the 90s, worked for a nonprofit hospital, could have had loan forgiveness decades ago, but it kept getting denied. So he was paying and paying and paying, but with interest, his balance just kept growing and he was making a payment and his balance grew. It's a terrible situation. So we worked with him. We changed his loan type. We applied for loan forgiveness. His entire balance of $650,000 was forgiven. I mean, this was such a change to his entire life, to his ability to retire, to his financial wellness to the nth degree. But these are stories that happen all the time, and there are no doubt employees with Head Start that are in situations that could be improved with some help with their federal student loans. So like Bill said, it's a great 1-2 punch. If we can help lower your employees' loans and then provide them with the Thrive program where an employer helps make the payment, you have taken somebody who was making let's say a $500 payment, and then their new standard, their new payment plan is 150 and maybe 50 is coming from the employer. So now they're making a $100 payment. That's a $400, break in their monthly budget. Where could those dollars be used? I mean, they got credit card debt, they want to save for retirement, they got their kids' schools. I mean, the number of things where they can use those dollars for is limitless. But what an incredible recruitment and retention tool for an employer to be able to provide this kind of, breath for your employees to give them a sense of, okay, I'm on track now for good things. Thank you, Head Start for allowing me to have this opportunity. So that's what we do. That's what we're here for. And we would love to answer any questions or help, your group in any way possible. So Bill, any last words?
No, I think you covered it very well. And I hope that for all those that listen to this later, this recording, that you will reach out. One thing you'll notice, there were some, in fact, if you can go back up to one of the slides that had a QR code, even right now, like Donna, you mentioned this is you, but you can scan that QR code that will take you right to someone that to a scheduling tool to one of our experts.
I don't
And
think that's on this website. I think that's on the other.
oh, did I see
Let me
one
see.
earlier? I thought I
I
did.
don't. Oh, you're right.
Yep.
There it is, right there.
Yep. So
So
that QR code, that's typically what we do is even brochures that we have, that's a scheduling tool. So I mean, I run into people at, my son's volleyball practice or at a party and just say, here's a QR code to scan because this is a big issue getting bigger. And it feels awfully good to go and help people that are in very difficult times when it comes to this financial stress.
absolutely. And we do have lots of different resources. So if you feel like there's something your group would gravitate towards, whether it's a flyer, whether it's a webinar, a video. So, I know every group is a little bit different in how they receive information, but in any way that we can help or offer some guidance or service, we'd love to help out.